Hi, everybody. Welcome to Stop Being Sold, a community of informed consumers who are sick and tired of being sold financial products they don't need or understand. So if you're tired of being a transaction, go ahead and hit that notification bell and also the subscribe button so you never miss another video from us. And also, if you like the content of this video, we'd appreciate hit the like button there. So it helps us grow our channel. There you go. Just hit that thumbs up sign. It helps us grow our channel and other people can find videos like this. How are you doing today, Brian?
Hey, doing great, Michelle. How about yourself?
Doing good. So today's topic, we are covering why working with a fiduciary is critical to your financial future.
Ooh.
And this is a really big one. You know, in past years, you never heard anything about a fiduciary advisor, and now you're seeing it more and more pop up. So we wanted to cover this one today for you all, just because it is really actually very important to not only understand the definition of a fiduciary, but also understand why working with a fiduciary is critical. So
Exactly. You're starting to see a lot of this, Michelle, the word fiduciary pop up everywhere now, including you're actually seeing TV commercials with it now. So
yeah, absolutely. All right. Well, without further ado, let's dive in. And why don't you give us the definition of a fiduciary?
Okay, Michelle, the true definition of fiduciary is a person or an organization that acts on the behalf of a person and is legally bound to act in their best interest. And that's the key word, legally bound by law to act in the best interest of that person. So,
okay. So what does that actually look like?
Okay. So for example, as a fiduciary, legally bound is, so Michelle, if you came to work with me and you were interviewing me as a potential new client, and me as your new advisor, whatever you tell me, I have to go and put my little blinders on and basically only focus on what your best interest is. What is your objective? What are you trying to accomplish? What do you got to work with? And then build a plan based on that. I've got to, and look, while them blinders are on, I can't think on the outside of, oh, how much am I going to get paid for this? Oh, do I got a product over here that, you know, it might not be the best thing for you, but it'll fit you, whatever. And I've got to put away any required by law to prevent a conflict of interest between me and you. Okay. So if XYZ company over here, for example, is saying, Brian, we got this great product. You got clients that'll fit? I don't know. And we'll pay you a bonus pushing our product over someone else. That's what's considered a conflict of interest. So 3 things. A fiduciary is legally bound to do the following. Legally and ethically, I've got to act in your best interest. Second, I've got to put your interest ahead of my own. And third, I've got to prevent any conflict of interest.
Okay. So really what that means is a fiduciary has to buy and sell investments that are in the client's best interest, not just suitable, but in their best interest based on their goals and what they're wanting to do with the money, their why, and okay, got it. Okay, so let's give an example. I think this is really important. You mentioned interviewing a fiduciary. So let's say that I have a 401k that has been left behind with an old employer. I've changed jobs. Or let's just say I'm about to retire and obviously I need to do something with that 401k. Can you give an example of the difference, like what it would look like to speak with a fiduciary or deal with a fiduciary versus a non-fiduciary advisor?
Oh, okay. This is pretty simple here. And just listen closely as you're watching this video, just listen closely and you will be able to hear the differences in the way a fiduciary acts versus an advisor that's only under suitability guidelines. Okay. So a fiduciary, Michelle, I've got to act in your best interest when I'm offering advice on rolling this 401k over. Okay. I'm going to ask you what your goals are with the funds now that you've left your place of employment. You know, you're retired, we might go one direction. If you just left your job and you're going to another position, we may do another avenue, go a different direction. Again, it's defined by what's happening right now. What is the best thing for you? Okay, so I've got to go out as a fiduciary and find you the best rates of what's available for and the terms for your new IRA account. If it goes to an IRA, we'll get to that one in a minute. Okay, so let's just say you're going to an IRA from your 401k. I've got to find the best rates and terms out there on the market. My job is to go find that stuff. Then once I find that stuff, I've got to offer transparency to you in the results that I've got from the research, right? So I've got to deliver the goods to you and say, look, here's the best offer for you. Here's why it fits you, and make that work. You truly have to define it to where you truly understand it. Then we got to go one step further. I've got to compare these findings with the old 401k to see if the transfer of that 401k from your previous company is in your best interest. Remember, I got the blinders on. I can't think of anything else except for, hey, what if I come back with my research, Michelle, and my research as a fiduciary says, Michelle, you need to leave your 401k
right
is, because that's your best option. Legally, I've got to tell you that as a fiduciary. And then let's say you decide that, yeah, I like the IRA. Now, Michelle, I've got to disclose to you what my fees are and how I get compensated. So that could be either a flat fee for managing your new IRA or a percentage of assets. I would legally have to disclose that in writing to you. You would have to agree to it and either initial beside it or sign off on it, right?
Right.
And in another thing, Michelle, I've got to show you how I make money. And that means as a fiduciary, the only way I make any more money is to grow your account. Let's say you have a $100,000 401k and we rolled over to an IRA, and let's just use 1% as an example. I'm charging you 1% or $1,000 a year to manage it. Well, if the account drops to 95,000 and I'm still charging that 1%, I lose money, right? But if it goes to 125,000, my fee for the following year is going to be $1,250. I get paid as a fiduciary to grow your account. It's a disincentive if I lose you money. So that puts you and me on the same side of the table.
Sure.
So there's the key.
One quick question on this. So that's you mentioned going from 100,000 to 125,000, your fee gets upped, right? Because you're growing it. That's when a fiduciary is paid a percentage of the assets.
Right. A percentage of
the
assets.
Some fiduciaries just take a flat fee.
Yeah, sure.
And in that case, the growing won't matter.
No, the growth wouldn't matter, which is okay to some point, because I mean, I understand why some charge just a flat fee. Yeah, here you go. It's $500 a year for me to manage your account, no matter what. Okay, that's great. But what's the incentive for me to really focus on growing that account if I'm going to get the same paid to $500 every single year? But again, it's all disclosed to the consumer. This is what I charge. And the last thing, as a fiduciary, Michelle, I've got to disclose to you any potential conflict of interest up front, and then you in writing, and then you would have to say, okay, I'm okay with that. And you'd have to sign off that, hey, there may be a conflict of interest here. So that's what happens when you work with a fiduciary. Them are some of the things that you must expect from them.
Got it.
And everything's in writing. You can't work with a fiduciary without signing a legal binding contract. So.
Okay, good to know. So one quick question on the fees, like when you're asking, the fiduciary has to disclose this. Fiduciaries are not paid commission.
No, there's no.
It's either the
commission.
Flat fee or the percentage of assets fee.
You got it. Yep.
All right. So let's talk about, we have 401k. We want to roll it over. What does it look like to work with a non-fiduciary advisor?
Okay. Some of the initial input is like defining your goals with the funds now that you've left your employment or you're switching jobs, whatever it may be, retired. That still has to happen, because even as a non-fiduciary advisor, you've got the rules. They're called Know Your Client, KYC rules. You've got to know your consumer before you can invest money for them. Okay. from them, that information that you give them, your net worth, your income, your liquid assets, that kind of stuff, they're going to determine products that are suitable for you. You didn't tell, I didn't tell you that I got my blinders on here, because I don't, because I'm not legally obligated to do anything except for find a suitable product. Okay. And legally, Michelle, there's no incentive for me to disclose any potential conflicts of interest to you. I don't have to do it. So I'm not a fiduciary. Fiduciaries by law have to do it. Today, I don't have to, because today I'm a non-fiduciary, wearing that non-fiduciary hat. And Michelle, I could have an incentive to sell my own higher fee products. So let's say I'm a registered rep and I'm working for a broker dealer XYZ over here. Okay. I'm licensed to sell mutual funds, ETFs, bonds, whatever it may be, variable annuities, whatever. I've got incentives to sell higher products and to sell products that are in-house products, because they may be paying me a bonus to sell them. They may be giving me a free trip to Hawaii. I might need one more sale to win that trip to Hawaii. So I've got my own personal incentives to write you whatever, hey, as long as it's suitable though. We're not going across the boundaries here. But what I'm saying is it's only got to be suitable. And that new product, Michelle, may be something like a variable annuity that pays me a commission on the product. Thus, if I'm getting paid a commission, doesn't that cloud my judgment a little bit as far as the product I deliver to you? There's the differences. And guess what? I didn't have to sign on the dotted line as the advisor saying that I had a legal obligation to work in your best interest. There is the difference.
Got it. All right. Thank you for explaining that. So if you currently have an advisor, how do you know that he or she is working in your best interest? Like, how do you know, like, how can you tell that they're—
First of all, number one, ask them.
So simple.
Michelle,
are you a fiduciary?
Are you a fiduciary? Are you working as a fiduciary for my investments, for my funds, for my accounts? Just ask them. And you're probably thinking, Michelle, aren't all advisors fiduciaries? No, they are not. There's many conflicts of interest out there today based on how an advisor is licensed. Okay. Only registered investment advisors, you might see an RIA beside their name, registered investment, are required by law to act in the best interest of their clients. Advisors who are not fiduciaries, Michelle, they operate under what's called a suitability standard, meaning that the products that they sell only have to be suitable to your needs.
Okay.
I don't mean they're in your best interest.
Best interest, right. There's a big difference. There's a huge distinction.
Big difference there. So,
right. Okay.
And if your financial advisor, Michelle, doesn't have a fiduciary duty to you, you know, they may be able to recommend investments or products that pay them a bigger commission over ones that would be the best fit for you, which can end up costing you even more money. And their judgment is definitely clouded by doing that because of the high commissions. So,
okay, understood. All right. So what are some other key questions that consumers need to ask before working with fiduciary? So obviously the first question is,
are you a fiduciary?
Are you a fiduciary?
Yeah. First and foremost, are you one? Yes or no?
Okay.
And
all right.
To some people, Michelle, I remember a young lady that was searching in our area on a local social media site. And she was looking around. She says, I moved to the area. I'm looking for a fiduciary. That was so exciting to see that people are finally recognizing that.
Right. And hopefully after this video, more people will be asking that question.
And she interviewed 3. Well, guess what? We were number 3. She was going to interview 7 or 8.
How many do you recommend people interview?
Like this young lady, honestly, until you get your right answers. How's that?
Okay.
And if until you feel good about the questions that they answered truthfully to you, you don't know these advisors yet, but use your gut. Your
Sure.
gut will tell you by the way they answer their questions. So like, first of all, ask them if they're a fiduciary. Second thing, which disclosure would you sign to be my advisor? Would you sign a disclosure telling me that you're a fiduciary? Yes or no? If they say no, you might as well walk, because that's not the person for you. It's that simple. And if they tell you up front, I'm not a fiduciary, I'm going to recommend products that are suitable for you. My license don't require me to do what a fiduciary does, but you get a good feeling about them. Remember, it's a two-way street. You got to feel good about them. They got to feel good about
It's
you.
a relationship you're building for the long haul.
About the relationship.
Right. Right.
You might find that advisor might say, hey, I'm a duly registered advisor, meaning you might hear it's called a hybrid advisor. I can be a fiduciary at times, or I can be a broker offering products that are suitable to you. But again, it comes down to how good you feel the relationship's going to be. You don't have to get a fiduciary. Do we recommend one? Yes, all the time. So.
Okay. All right. So what's another question? Let's maybe do 2, 3 more.
Okay. Michelle, here's a question. Are you independent, or do you work for a firm?
Okay.
And let me explain why that matters. Okay. So I'm an independent. When I first started in the industry years and years ago, I was back with the old Smith Barney. And that was an old name from centuries, you know, but I was with Smith Barney, and I was not independent. And I learned in the early years that the only products I'm allowed to give them were products that were offered by that broker dealer, right?
Okay.
And well, that don't make sense, because over here is another product that truly would make a better fit for the consumer. But because I was not independent and I worked for a firm, I could only use their products. So that would be in the last question, that would be a registered rep that works for a firm. Okay.
Okay.
And there's why it matters today. And after that, so I was only there like 2 years, and we went independent after that, just for that big reason, because there was better stuff for my clients.
Sure.
And we've been a fiduciary ever since. So also, here's why it also matters. Who makes the decisions on what investments to give to the consumer? As an independent, Michelle, it's me and the client sitting across from me.
Sure.
That make the decisions. There's no one else involved. Once you figure that out, you get that information from them, you find the best thing that's available for them, and then that's it. If you work for a firm, Michelle, they may push their own proprietary products, which may have much higher fees. Sure. And may not be in your best interest. There's why.
Okay. Okay. Got it. So let's just do one more question just for time here, that we could probably go on, and we will have more on our blog, and also shoot more videos with these questions, more questions. But I mean, let's just wrap up. Obviously, one of the conversations that needs to be had, or the questions, is how are you compensated?
That's a big one. This is huge. Now you'll tell how if your advisor is a fiduciary or not. It's that simple. Okay. You get fees, you get commissions, or do you get both? And that determines, if they're a true fiduciary or not. So they should be able to tell you, Michelle, clearly in written terms, how they are compensated. And so, for example, they could charge you a flat fee, or a fee for percentage of the assets, like we talked before. Okay, the only way that advisor can charge you more money, Michelle, is to grow your account. Okay. They've got an incentive to grow your account, because they then will earn more money as the advisor if they're charging for a percentage of assets. Now, the other scenario is they get paid a commission. If they get paid a commission, they're not a fiduciary. They can only find the best product that's suitable to you. And this, by default, Michelle, this creates a conflict of interest immediately, because they can offer a higher commission product that benefits them personally more than it may benefit you.
Okay. All right. Got it. So I made the decision it was the last question, but I should ask you, is there any other question that you want to share with viewers right now before we wrap up?
Well, you can ask them one more thing. Well, if you haven't made up your mind in the first items, ask them, do you get paid any backdoor payments or revenue sharing agreements from custodians or from fund families? And here's why this is important. Many firms get backdoor payments for recommending certain funds or fund families or even custodians. And sometimes you'll see them, they're called revenue sharing agreements. If you Google revenue share agreements, you'll see massive class action lawsuits against these companies because of this. Fiduciaries will not do this, as they're required by law to disclose that conflict of interest. If they disclose look, can fiduciaries have backdoor payments? Yes. They will disclose them to you if they do have them, and you have to sign off on it, and you've got to feel good about it to even work with that fiduciary. Okay, got it. All right, well, this has been really thorough. Thank you so much. Eye-opening? Yeah, right? Thank you for thank you for the breakdown. So if you like the content of this video, please give us that thumbs up sign so we can grow the channel and other people can find videos like this. And we also know that you like what we're putting out there. Go ahead and subscribe if you haven't already. A lot of our viewers aren't subscribers, so go ahead and do that. And lastly, if you have any questions about fiduciaries or just any questions about working with an advisor, drop it in the comment section below, and we're going to be doing a lot more videos on fiduciaries, working with fiduciaries, I should say, so we can address those questions in our next videos. So thank you for watching, everybody, and thank you so much, Brian, for the breakdown. Thanks, everyone. Thanks, Michelle.